them. A lot of this there are examples that you can walk through in addition to the ones that we do together, so I give them to you. I think this is where we left off on Tuesday. We talked about accounts and what that means, the general ledger. Today we'll practice using T accounts, because that's our shortcut for the general ledger, and we'll practice some more journalizing and posting. So just to kind of review, and if you were here on Tuesday, right? You guys remember? It's funny, I said yesterday to a class, do you guys remember what we did Monday? And half of them were like, no. Okay. You know, these are basically T accounts, right? And they're obviously T accounts that represent the entire classification of assets. But, you know, I would have a T account for cash, accounts receivable, supplies, all my liabilities, my equities, my revenues, expenses, individual revenues and expenses. And those are T accounts, and these are these are the debit and credit rules. So we filled this out the other day together so that you had something, a quick guide, I'll call it, to look at when you were journalizing. We practiced journalizing a little bit. Some of you realize you're kind of rusty on that, right? Just the whole purpose of this. And so, you know, if you kind of hang on to this and you have this as a reference, I also posted a blank one in Canvas for you in our little notes packet area of the weekly module, so you always can print out a blank copy, and I always have them handy as well. But these are T accounts, and you know, if I go back to the PowerPoint here, you know, account title at the top, so that's for your specific account names like cash, accounts receivable. Every account needs to have its own record of increases and decreases. And so we know that the left side, we talked about the fact that this T account, some characteristics include debits and credits. The left side of that T is always the debit side, and the right side is always the credit side. Now, the terms debits and credits don't mean the same thing for each account classification. For example, as we discussed, assets increase with the debit and decrease with the credit, but liabilities and equity increase with the credit and decrease with the debit. So those are the rules we're referring to. And in accounting, we call accounting the language of business. And just like any new language you learn, you got to learn to speak the language. And sometimes words that have meanings that you're familiar with don't mean the same thing in another language, right? And so instead of using the words increase and decrease in accounting, accountants like to say debits and credits. And so all that means, all we're doing is we're translating those increases and decreases into debits and credits. So you ask yourself the question, when I have an economic event or transaction that impacts an account, like cash, you've got to answer the question, does my cash increase or does my cash decrease as a result of this transaction? And then you take, if it's increase, then you look at your rules and say, well, that would be a debit, right? If it's decrease, you look at your rules and say that would be a credit. So there's a method for figuring that out. I'm not going to go through all the rules. I already gave those to you, right? And they kind of lump them all together here. Look. And maybe this is the easier way for you to remember this. Listen, I don't assume that the way that I give you is the best way all the time or the best way for everybody. There are many different ways to explain most of what we cover. And I try to pick the way that I think works the best for most students. If you really want to summarize these rules into 2 T accounts, right? You want to summarize them into 2 T accounts. The one on the top, assets, expenses. Now we haven't really talked about losses yet, but a loss is just like an expense. Losses and dividends all have a normal balance of a debit. When I say normal balance, what do I mean? Yeah, the plus side. Where you find the plus side. The plus is on the debit side, so the normal balance is a debit. Is it normal for our cash to be negative? No, it's not. So we want cash should have a debit balance. Then you have liabilities. Paid in capitals, like your common stock, revenues, paid in capital and retained earnings, revenues and gains. Those all have a normal balance of a credit. The plus side is the credit side. So you could condense your rules into just those 2 T accounts versus the flow chart that I give you. I don't care which one you use. I want you to use the one that makes the most sense for you, okay? I like to give you guys choices now at this point. Like there's going to be a couple of ways of doing certain things, and whatever you're most comfortable with and however you can remember things best, that's the way you should pick. It might not be my way, and that's fine, okay? Let's see here. So basically, what we have here is we basically have examples of transactions where we are looking at the accounting equation in T account form and we're making adjustments. Now, I'm honestly not going to stand up here and read all these to you. And the reason that I'm not going to do that is because we're going to practice that together. Some of this is just extra examples for you to kind of reference if you need them. Here, again, is the detailed breakdown of the accounting equation with debits and credits, increases and decreases. And this is pretty much the same thing as the handout that I gave you, right? I mean, I've added to my handout the financial statements, and we know these are general terms. We now know that our income statement has a more formal title, right? Comprehensive statement of operations, right? Anyway, but you know, this is kind of, like I said, this kind of has a little bit of everything in it to just have as a guide. And here is obviously the rest of the breakdown. So this is pretty much the flow chart that I give you on paper that I put on the board. It's just here in a PowerPoint too, okay? And then the general ledger. So we'll review general ledger accounts. Every account in the chart of accounts also has a ledger account. And the purpose of the ledger is to keep a running balance of each of my accounts. So for example, cash, right? Now, you guys remember what a subsidiary account is? It's a secondary record, yeah. So let me give you an example. We've got a primary record versus a secondary record. All right, and accounts receivable is a great example to use here. So we have accounts receivable, and this is my general ledger account. Obviously, I'm using the T account as a shortcut, okay? The plus goes here, minus goes there. And this represents the total, this value in here. And there's going to be all kinds of transactions in here, right? There's going to be stuff happening throughout the year. But at the end of the year, for example, on December 31st, whatever this balance is, represents the total that's owed to me by all customers, right? Now, again, who are we preparing financial reports or our focus? What's our focus primarily for? Internal or external in this course? External, people outside of our organization, right? So this is accounts receivable. It's an asset. It goes on the balance sheet, right? And so when somebody external to my organization is looking at my financial statements, they look to see what the total accounts receivable are. Do you think they're concerned? Somebody that's not affiliated with your company, other than the fact they might own some of your stock, or the bank's trying to decide whether to give you a loan. Do they care which of your customers owes you money, their names, addresses, balances, individual balances? Do you think people external to the company care about that detail? They don't. They just want to know what the total owed is. They don't have, and by the way, there's a privacy issue there too, isn't there? Yeah, you can't just, just because someone asks, hey, who owes you all that money, you're not really going to be allowed to tell them, especially, if you've got some kind of contract with your customers, those types of things. So this is what we see on our report that goes to external users, right? So this is for external reporting. But listen, I know that if I don't send balances to all these customers that owe me money, am I ever getting paid? No. So the secondary record, another word for that, and sometimes we call this the control account, by the way. This primary record is called the control account, okay? Over here we have the subsidiary, which is the AR ledger. And here's where I'm going to find the details or the breakdown, right? And I got 3 T's, so how many customers do you think I have? I got 3 customers, yeah, right? And so the balance is, I've got individual customers here. And let's just say, these 3 customers at the end of December 31st, or at the end of the period, or whatever it might be, the sum of these individual balances need to equal what? You need to equal what? This number over here. So all this is the breakdown, right, of this. This is for internal purposes because I know that if I want to collect money from customers, I got to send them a bill. In order to send them a bill, I need to know their name, their address, I need to know who the contact person is, and I got to keep an individual record for all of their transactions, right? And so all of the activity in each of these three accounts, the net of that activity, when I add it all up, it has to agree with that. So there are lots of accounts that have subsidiaries. Can you think of another one where I have one main account that would represent the total, and then I would have a secondary record where I have to keep the details about all of those individual types of that account? Before we get to the rest of that. Yeah, so for revenue though, you know, it's interesting. You might have just more than one control revenue account. So you might have different streams of revenue. And since revenue is so important, you might actually not have necessarily a subsidiary. You might have maybe 4 revenue accounts. Like you could have 4 cash accounts too, multiple cash accounts. I'm thinking of something else. What's the opposite of accounts receivable? Accounts payable. I mean, I don't know about you, but if I don't get a bill in the mail or digitally or whatever, I'm not going out there just randomly paying bills, right? I mean, you've got to be kind of prompted to pay your bill. And you do that through the receipt of an invoice or something like that. So, but if I'm a business and I'm receiving invoices, then I probably have a list of all of my accounts payable, my vendors, my suppliers. I have a relationship with them. So I got to know their names, their addresses, who my contact person is, what my credit terms are. What do I mean by credit terms? Oh, come on. Yeah, like how many days do I have to pay my bill? You guys remember 2% discount if paid within 10 days, net due in 30 days. So your credit terms are 30 days basically, right? Some vendors you might have relationships with, you get 60 days to pay. So I need to know that so I can plan for my payments. And there's a strategy to planning those payments. You want to plan payments for when you have cash, right? So there is definitely a kind of a cash flow strategy there. So we talked about AR. I'm going to make a little list here. Accounts receivable, accounts payable. These are likely accounts that likely have a secondary record. What else? Start with the balance sheet. Okay. Cash, you probably have a couple accounts, but they're probably all primary. What comes after cash? Accounts receivable. What's next typically on the balance sheet? How about merchandise inventory? You think if you are Walmart, how many different types of inventory do you think they sell? Tens of thousands. And so there's got to be a system that's keeping track of the individual kinds of inventory and individual transactions associated with those inventories. Because you think about Walmart, they have perishable goods and non-perishable goods, right? What do I mean by that? Yeah, goods that expire and goods that don't, right? And again, it's a constant inflow and outflow of inventory. Well, all those individual items have some sort of code on them, right? Why do you think they have a code? Well, in order to keep track of them. So every category, and within the category there would be details. So like one category might be dairy, right? I mean, milk, it's not just milk. There's other types of individual products that would fall under the dairy category. And within their dairy category, there'd be individual records. Can you imagine how big the subsidiary ledger is for like a Walmart, right? Or a Costco? It's pretty robust, right? Okay, let's keep going down the line here. You guys look so excited. I can't help myself here. Let's keep going. What comes after inventory? Think of something else that might have more than one. Payroll. Okay, so employees, but that's not going to be under assets. Let's stick with assets just for now. You're not wrong. He's right. Employees. But the thing with employees, you got to be careful here, okay? Your individual employees would be that secondary record. So you jumped over to the other side, which is fine. We'll say, so we got a salaries payable, right? It's not just the salary of one person. That salaries payable is the salary for all my employees, okay? What else? Equipment. Yeah, so Equipment is super general in name. You have to have a secondary record that would list all the individual types of equipment. If you had a business where you had a fleet of vehicles, you might have an account vehicles and a secondary record that would list all the individual vehicles that you own, because some of them would be older than others, right? Some of them might have more mileage. Some of them may have different repairs and maintenance done to them, and you want to have an individual record of each of those. So there are, well, I'll stop there, but there are quite a few accounts where when you look at the balance sheet is just the total of all. There's got to be a secondary record somewhere else with the detail, okay? So we break down our general ledger accounts into what we call permanent or temporary. This is important, folks. Look, permanent accounts are accounts whose balances roll over to the next accounting period. So and you can see there, it's assets, liabilities, and equity, right? So if you want to look at and kind of look at it this way, this is kind of easy. Well, I think it's easy. So these accounts right here, these are permanent. In other words, they don't zero out. We don't zero their balances out at the end of the year and start all over with accumulating their values. Does that make sense? I mean, think about it. Cash is an asset. Does your cash account at the bank zero out on December 31st and on January 1st, or zero out at the end of the year and on January 1st you start all over? No, that's crazy, right? I mean, if you got $5,000 in the bank on December 31st and you wake up January 1st, you should still have $5,000 in the bank. It rolls over to the next period. Now, our liabilities, our debts do the same thing, right? It would be nice if we woke up and January 1st all our debts were gone, but that's not how it works, right? These accounts down here, these are temporary. And what we mean by temporary is that their balances get closed out at the end of an accounting period, and we start keeping track of them all over again at the beginning of the next accounting period. We'll say fiscal year is January 1, okay? They're temporary. Think about it. Here's a great example. Well, I think it's a great example. Your paycheck stub has, you guys ever look at your paycheck stubs, by the way? You can lie, or you can tell the truth and say you don't. You really should look at them, though. There's a lot of interesting information on there. You know you're not getting your gross wages, but do you really know where your money's going? That's for another conversation, right? When you look at your paycheck stub, you have your current pay, and then there's a part that says year to date. What does that mean? It's an accumulation, right? So I got paid today. Woohoo! I got paid today. It's August 31st. So on my paycheck stub, there's an area that shows me the calculation for my net pay, to be my gross wages, and then be all my deductions. And I feel like that's maybe that's on the right side of my paycheck stub. And then on the left side, or maybe it's the other way around, I don't know. One side has my individual, like for just the payroll period, which would be August 16th to the 31st. Then I have a year-to-date section, and that year-to-date section shows the accumulation of all my deductions, my gross pay, my net pay, up to January 1 through August 31st, okay? Now, what happens on December 31st with my year-to-date? Well, actually, what happens on January 1st with my year-to-date? What do you suppose happens to it? Does it keep rolling over to the next year? It resets to zero. So January 1st of 2024, my year-to-date, all my year-to-date numbers are going to be zero. And think about it, those are my revenues, right? My paycheck is my revenue, it's what I earn. When you file a tax return, here's another way of looking at it. When you file a tax return, don't you file it for just a one-year period? And what the government wants to know is how much income you had from January 1 to December 31. How many, and your expenses go on your tax return too, personal tax return. So January 1 to December 31. Then you start all over again the next year with a new 12-month period. It's the same exact thing for businesses, okay? So assets, liabilities, equity, permanent, balances roll over, revenues, expenses, dividends, they reset to zero. You'll get to practice that when we do closing entries with our little project, okay? So and remember, in accounting, to close something means to zero it out. So close means to zero out. And write off means to remove from the records, because again, language, right? Got all this language here. Write off means to remove from accounting records. Remove from, there we go. And what I'm not going to go through here, because we're going to go do our own, which is so much more fun than me standing up here and reading all this to you, but you should review this, right? Here are examples of transactions, and in the slides that follow, you've got all of the recordings of those transactions. Again, I'm not going to stand up here and read these to you. This is a great review, though. You should practice these. One way of practicing would be to start here on a blank sheet of paper and see if you could journalize these. Now, again, we're going to do our own together here momentarily. But I provided these to you as just an extra resource, okay? So these are all those transactions. I'm going to kind of skip over the periodic inventory system for now. Some more transactions here. And so a good bit of the slide, there's a lot of slides in this chapter. I try to be very intentional when I pick slides so that like I'm not just handing you a big packet and reading slides to you. I only left these in here so that you had another example. All right, so once we journalize, we're going to do that together here momentarily, and then we're gonna complete some of these steps here. We're going to post. Does anybody remember what the word post means? Did I mention it the other day? When I post something, nobody wants to take a gander? The word post means to transfer in accounting. Where am I transferring numbers from? I'm transferring from the journal to the ledger. And what's our shortcut for the ledger? It's the T account. Okay? So they give you some examples of posting. Here's a journal entry. We've got a debit to prepaid rent, a credit to cash, and you'll see how the debit to prepaid rent has been transferred to the T account. And look, it was debited in the journal, so we put it on the debit side of the T account. That's pretty easy to remember, right? Cash was credited, so we put it on the credit side for cash T account. You guys have done this before, right? So we'll practice that today a little bit. This is a collection of all, now the T accounts, remember, they're our shortcut, right? We don't want to draw ledger accounts, just want the T's. This is basically the collection of all of my general ledger accounts after I journalize and I post, okay? At this point, I want to make sure that I've journalized and posted correctly. Can anyone remember what comes next? What do I prepare to make sure that I've journalized and posted correctly before I move on to adjusting entries? Trial balance. Do you guys ever, like if you play sports, you run a play, you do a practice run of the play, you do a trial run, right? It's like before the real thing, yes? You know, if you're running a marathon, you don't typically run 26 miles every other day. You build up to run the marathon, right? And you might run so many miles before you run the marathon, but you never run in like the full 26 miles until race day, typically, if that's how typical training goes, right? But you have a practice run, and that's what a trial balance is. It's a point at which you stop and say, I got to make sure that I journalized and posted correctly in the first two steps before I move on, because what happens if you made a mistake and you move on? We got the domino effect, right? You guys know what I'm talking about, right? That mistake carries forward. So everything after that point's wrong. So the trial balance is a place where we stop, we make sure that our debits equal our credits before we move on to adjustments. All right, so I'm going to stop there for just now, and I'm going to jump over to the textbook, and you're going to come with me. So we're going to do some problems here together. I need you to turn to page 92 of your textbook. I need you to get out some paper, a pencil, a calculator. We are going to have a good time. I'm going to change up the instructions just slightly here. did I say? Page 92. Book checks next week. Everybody better have a book. You guys can share a book. I don't care if you're sharing, but you need a book. All right. So, exercise 2-1, transaction analysis. All right. So we're at the very beginning of the accounting cycle here. Where we identify economic events and we decide if we have to journalize them, write them down, memorialize them so we can come back to them later. Okay, in real life, I would have source documents, right? Things that come across my desk that let me know, hey, I got to record this. But this is a classroom, so we don't have source documents. Instead, we have a list 1 through 9 of transactions that are taking place that need recorded. Okay. Now, this particular exercise says to analyze each transaction in terms of the expanded accounting equation. And then exercise 2-2 says to journalize them. So we're going to actually just journalize, okay? We're going to journalize. Now, what I'd like you to have in front of you, unless you've already got this memorized and you're very confident that you know this, is that handout, that guide I gave you, so that has your debit and credit rules on it. Because I'm going to be kind of slow and methodical with each of these. And I'm going to ask questions. I'm not going to just stand up here and write out answers. You guys with me? I'm just going to do the journal entries on the board. You can just do them in your notebooks. When I give you the graded problem for the chapter, it's going to have pretty much everything that we've talked about so far in it. I'll give you actual journal paper, okay? But I'm not going to give you journal paper right now. Just do it in your notebook. All right. Any questions before we get started? Okay. So it says the following transactions occurred during March 2024 for the Wright Corporation. Company operates a wholesale warehouse. And so number 1 says issue 30 shares of no par common stock in exchange for $300,000 in cash. So we're gonna apply the exact same process to every transaction. The first thing I'm gonna ask you, remember, you have to have at least 2 accounts that are affected. So you gotta identify 2 accounts. Now, again, in real life, they would give us a list of the accounts. We'd have a chart of accounts to pick from. I wish they would have done that, but these are just exercises. So it's nice when we kind of know, okay, here's the accounts we have to pick from. It's kind of like a word bank in a fill-in-the-blank test. That's the kind of test you want me to give you, fill-in-the-blank? Who likes fill-in-the-blank tests? They're not as awful if you have a word bank, right? But I always tell students, the chart of accounts is kind of like your word bank for your journal entries. It gives you a list of all the accounts you have to pick from. The names of these accounts are fairly general, so we'll just stick with general names. So what 2 accounts are impacted? Common stock and cash. Now remember, we are doing the journal entries for the Wright Corporation. The Wright Corporation has sold stock to investors in exchange for cash. So what is the Wright Corporation receiving? Cash. We want to increase the value or the balance of cash. How do we do that? With the debit. So we're going to debit cash for $300,000. I'm going to try to at least be consistent here with my debit and credit columns. And what am I crediting? Common stock. Common stock, if you look at your rules, is an equity, falls under equity, right? It's a sub-account of equity. And the normal balance, or we increase that with a credit, right? Now, if you really wanted to kind of do this with the accounting equation, look, we did this a little bit the other day. Look, under assets, we've got a $300,000 increase, specifically cash, and over on this side, under paid in capital, we've got $300,000 of common stock. I'm going to bypass that particular part, but okay. You guys with me? Ready for number 2? All right, number 2 says, purchased equipment at a cost of $40,000. Cash of $10,000 was paid, and a note payable to the seller was signed for the balance owed. So it's like, you make a down payment, like you buy a car, you make a down payment, and you take out a loan for the rest of it. That's exactly what this is. So we have 3 accounts that are impacted here. Who can tell me what 3? Go ahead.
Equipment expense, cash, and note payable.
Okay, you're like 95% right. Take the word expense off equipment, because equipment is an asset. You depreciate it later, and so a portion of the cost of that will be expense later, but when we first buy it, it's just an asset. So very good. So we have equipment, we have cash, and we have notes payable. Now, let's start with equipment. The Wright Corporation had no equipment before this, and now they have equipment worth $40,000. So we want the value of the equipment account to increase, don't we? How do we increase equipment? Yeah, because equipment is a what? Asset. Things that we own to run the business, right? Now, remember, if I was doing assets equal liabilities plus equity, and sometimes this might help, I just got an asset worth $40,000, right? Where did the funds come from to buy that asset? Well, in this case, I used two sources. What was the first source? Cash. And if I paid out cash, what happened to cash? The balance decreased. So how do I decrease cash? Debit or credit? Credit. Look at your rules, right? So I'm going to credit cash for $10,000, right? And it says the remainder, the balance owed, which is how much? And I know my debits have to equal my credits, right? So I know that my other entry has to be a credit for 30, correct? Debits have to equal credits all the time. And what account? Notes payable. So let's talk about notes payable. What kind of account is notes payable? What category? And if I had zero debt before this, because clearly Wright Corporation didn't have any other debt, and now they took out a loan, what do you want the balance of that account that represents that loan to do? Increase or decrease? Went from 0 to 30, right? You went from no debt to now 30,000, an increase. So how do we increase notes payable? With a credit, because it's a liability. Liabilities increase with the credit. So you got to trust the rules. Even if it doesn't make sense in your brain, and a lot of times it doesn't. You got to trust the rules. That's why I want them in front of you. Number 3. Purchased inventory on account at a cost of $90,000. The company uses the perpetual inventory system. We'll talk about that in a second. But what two accounts are impacted here? Merchandise inventory, we'll call it, and accounts payable, right? So merchandise inventory is what classification of account? It's an asset. We didn't have any before, and now we're buying $90,000 worth. So we want the value of that account to do what? Increase. So how do I increase merchandise inventory, which is an asset? The debit. The question then is, where did I get the funds to buy the merchandise inventory? Well, what does on account mean? Yeah, it's on credit. In other words, I got the inventory, but I didn't pay for it yet. I'll wait till the supplier sends me a bill. We call that, and somebody already said it, accounts payable. So my accounts payable is a debt. I didn't have accounts payable before, now I do. So the value of that account is also increasing. How do we increase accounts payable? It's a liability with a credit. Again, where are the funds coming from? They came from me incurring a debt. All right, you guys ready for the next one? Sales, number 4. This is 2 entries. I'll give you a hint. It says credit sales for the month totaled $120,000. The cost of goods sold was $70,000. So we'll start with the first sentence. Take one at a time. Credit sales for the month totaled $120,000. What 2 accounts do I need to help me report here? Accounts receivable, that's credit sales. It means I didn't get cash, right? And some revenue account. Specifically, we'll just call it sales since it says sales, we'll just use sales. So what do I want the balance of my accounts receivable to do? Increase or decrease? Increase. I didn't have any before this, and now I sold a bunch of stuff and people didn't pay me. Accounts receivable is what kind of account? It's an asset. So how do I increase an asset? With a debit. Sales is what kind of account? What category? Revenue. How do I increase our revenue? With a credit. Guys have rules in front of you, look at them. What's the other logical approach I could take here? Well, I already know the debit, so the other half of this has to be a what? I need a debit and a credit. My debits always have to equal my credits. I need one of each, at least one of each, and they have to equal. So if I was certain that I was debiting accounts receivable, then I have to assume that the credit has to be the other account I've identified. Okay? Second part of that, the cost of goods sold was $70,000. What does that mean? What it costs for us to either buy or make the goods that we sold. It's our expense. You guys remember what account I used to represent the cost of the goods that I sold? Cost of goods sold. What kind of account is cost of goods sold? What category do I put that in? It's an expense. Very good. Remember I tell you guys, cost of goods sold is the only expense account that doesn't have the word expense in it. It represents when I have a store, I mean, it's a huge expense because it represents the money that I spend to put inventory in my store. I have to do that before I can sell anything, right? So it's expenses, we always what, for the most part? Debit, yeah. So I'm going to debit cost of goods sold for, did it say 70? And what exactly did I sell? Inventory, thank you. And so if I sold it, I no longer have it. I want the value of that account to decrease. How do I decrease merchandise inventory, which is an asset? With a credit. All right, you guys with me? Number 5, paid $5,000 in rent on the warehouse building for the month of March. 2 accounts impacted here. Well, when you pay something, what do you use? Cash, right? And this is rent for the month. What category does that probably fall in? I gotta rent a building out or a warehouse out so I can run my business. Right, expense, yes. So I just got done saying that for the most part we debit expenses, right? It's very rare that we credit an expense. And if you think about it, anytime you pay cash, what do we do to cash? We credit it, don't we? Anytime we receive cash, it's a debit. When we pay cash, it's a credit. So this is going to be a debit to rent expense and a credit to cash. I already forgot how much. 5,000, yeah. Number 6, paid $6,000 to an insurance company for fire insurance and liability insurance for a 1-year period beginning April 1st of 2024. So remember, this is March of 2024. You are, hint, hint, prepaying your insurance for a whole year. So what 2 accounts do I want to use here? Prepaid insurance and? Very good. What kind of account is prepaid insurance? It's an asset. Why is it an asset? Remember, all of these transactions are March. Well, that's true, but what does that mean exactly? They do, but when's the period actually starts that they owe you the insurance coverage? In the future. So let's just say, for example, like when I buy an insurance policy, I own it. If this person were to decide the next day to cancel the policy, they get all their money back because April hasn't happened yet. So I heard somebody say expense. It will become an expense after the policy begins to expire. Each month, a portion of the policy will expire. But for now, it's an asset. So we're going to debit prepaid insurance. And we're using cash to pay for it. Again, forgot already what that was, $6,000. And we credit cash. Okay? You guys with me so far? Number 7, paid $70,000 on account for the inventory purchased in 3. So let's go back to number 3. Here's number 3. Let me ask you this, are we buying the inventory again? In number 7? What's it say? First word. Paid, what's that mean? Cash, immediately think cash. Paid, cash goes down, cash is a credit. What am I paying? What am I paying on from that transaction in number 3? I'm paying my bill. Accounts payable represents my bill. When you pay your bill, don't you want the balance of your bill to go down? Accounts payable represents the balance of the inventory bill. So if I want to decrease accounts payable, what do I have to do to it? I have to debit it. And that's good, somebody looking at their rules. Accounts payable is a liability. When you pay your credit card, when you pay the vendor, you want it to decrease, you debit it. And that was $70,000, right? And I use cash to do that. Okay? Number 8, collected $55,000 from customers on account. What did I collect? Cash, so I'm going to debit cash. 55,000. What does that get applied against? Accounts receivable. Customers paid their bills. I don't know about you, but when I pay a bill, I would like my payment to go onto my bill and reduce what I owe. Now, did they receive everything that was owed to them on their accounts receivable? What do you have to go look at? How about number 4, right? Number 4, a debit to accounts receivable for 120. This is a partial payment, but it's a payment anyway, right? And then last but not least, recorded depreciation expense of $1,000 for the month on the equipment. Who remembers that journal entry to record depreciation? That's going to be my credit. What's my debit? Depreciation expense, right? So I'm going to debit depreciation expense. I'm going to credit accumulated depreciation just for the amount given, which is $1,000. You guys with me? Now, I am going to let you, I'm going to pause here for a sec. I want you to draw a T account for all of these accounts. Okay, so we need, I'll tell you what they are. I'll tell you at least what the accounts are. We need one for cash. I'm going to make a list. Cash, accounts receivable, merchandise inventory, okay, equipment, oh, I missed one, hold on. Prepaid, let's do prepaid insurance. Equipment, accumulated depreciation, accounts payable, notes payable, common stock, what else do I have here? Sales, cost of goods sold, rent expense, and depreciation expense. So I want you in the next minute or two here, I'm going to ask you to draw a T account for each of those. I want you to place a DR on the left of the T and a CR on the right of the T for each of those. So the account name goes at the top. So for example, you'll have this for cash, right? Each one of those accounts I've listed over there gets a T, general ledger. This is also what I want you to do. Look up here, put the rule. This is another way of practicing your rules. Put the plus and the minus where it goes. Okay, I'm gonna give you a couple minutes to do that. And then I'm gonna show you, we're gonna leave my journal entries up here and we're gonna talk about posting to the T accounts. just need you to just draw the T accounts. We'll do the transferring together here. Draw the T accounts. Put the title of the name at the top of the account. Put a DR on the left side, a CR on the right side. See if you can put the plus or minus in the right place. It's all the only place I want you to start for now. If you want to start posting, you can, but I'm going to do it with you up here too. Everybody have their T accounts drawn? Just wanted you to draw the T accounts. Ready? I'll go through. If you started to post, that's okay, but you just need a T account for each of these. All right, so post means to transfer, right? So here's how this is going to go. And I'm going to kind of go to the board, and then I'll show you up here. Look up here. So we debited cash for $300,000. We credited common stock for $300,000. You're going to go to your cash T account. And you're going to insert $300,000 on the debit side. You're going to put number 1 next to it because that's a reference to the actual transaction. So I'll try to do this without showing you too much and getting you. Hold on a second here. I need a blank piece of paper. And this might not be perfect, but it'll do. So if we're looking at, this is probably not great. If we're looking at the, oh. No, we're not looking at anything right there, huh? We're looking at the cash account, right? What is happening? I'm not doing anything, right? Like, this is, you guys, is this happening to you too, or is it me? Okay, good, because I'm like feeling like maybe I didn't drink before I came, I promise. Okay, so the balance was 0, right? Stop. I had an issue with this recording, not recording and anything anyway the other day, and then they were in here messing with it this morning. So anyway, I hope you guys can catch that while it's in the clear there for just a second. So we're debiting, oh my gosh, that's bad. Okay, let me see if that I can't just like, yeah, I must not have liked all my extra paper. All right, so here's the debit, right, for $300,000. We go to, and yours may be in a different order, it's fine. Here, oh no, look, it's doing it. What the hell? Here's the credit to common stock, right? So you want to do that for each of these, yes? I'm going to give you a couple of minutes to do that. In the next one, you're going to go to the equipment T account. You're going to debit equipment for $40,000, put a number 2 next to it. You're going to credit cash for $10,000. You're going to credit notes payable for $30,000. Do you see what you're doing? All you're doing is taking the journal, transferring the debit or credit and the amount to the T account. Christine? Nope, you don't have to have a 0 balance there. You don't. That's a great question. See how they all say 0 balances of 3-1? You don't have to do that. I just assumed all the balances were 0 at the beginning. So I'm going to give you a few minutes to do that, and then we're going to compare. You might have listed your accounts in a different order. It's okay. When you're done posting, you balance the account. So you take everything on the left and add it up. Take everything on the right and add it up. Take the difference between them and put that value on the side where your plus is. So for example, and this is, I was trying to save some time here, but this is like this, right? and it goes this way. Someone tell me what accumulated depreciation, what the signs are. Very good, minus plus. And I think there's a couple on the other side here. All right, that's what I mean by DRCR plus minus, okay? Everybody know what they're doing? Okay, so the goal is to post so that you can obtain an ending balance, right? So if we think about why we're doing what we're doing, we're journalizing, we're writing down the events and activities that change our financial position, we're just memorializing the event. That record of the event, this doesn't give me these records here. These are just a record of the specific or individual events. They don't tell me the balance of anything. If I want to figure out the balance of each individual account, I got to post to the ledger, and then I got to balance each individual ledger account. Okay? I need the balances to prepare my financial statements. That's where we're going with this. We're not quite there yet, but you guys can compare your postings to mine up here. If you have questions, please ask. But I'm assuming at this point that I think everybody can do that. And if I'm making that assumption and you can't, please see me, and I will certainly go through this with you. But everything on the left, add it up, or add everything up on the right, subtract the two. Why is this balance over here? Because the debit should be greater than the credit with my cash account, right? The normal balance, the plus side, that's where you should be inserting your balances. If you have a negative balance, you're gonna have to go back and see where your mistake is. You shouldn't have negative balances. This is great practice for the graded problem. Is everybody okay down through accumulated depreciation there? Are you sure? And listen, folks, I'm not, I know some of you may, how many of you have a book on your laptop? Anybody? A couple of you, okay. Those of you who are doing something else on your laptop, not wise, because this turns into practice, or this is practice for a graded assignment. You're doing something else and you're not paying attention. Use your class time wisely. I'm walking you through all these steps so when it comes time for the graded assignment, you know how to do it. You're doing something else on that laptop, you're not obviously paying attention to what I'm doing. All right, so I'll move this down here to catch some of this. This thing has a mind of its own. I don't know what's happening, but there's accumulated depreciation and accounts payable, notes payable, common stock. The rest of mine are on the next page, so I'll wait till everyone catches up here. Nope. Oh, you mean like, you mean like this? Like here and here? Well, technically, kind of, yeah. Because this is an individual transaction and this is the balance at the end of the month, so yeah. I was thinking of something else and I answered too quickly. We good on this, the rest of these T accounts? Can I flip the page? Holy heck, what? I don't know what the deal is really. Like, I mean, there's been a lot of things that have happened with technology in this room. This is certainly not one of them. Oh, yes, Christine, sorry. What's up?
Okay. Is there like a list that we can access that kind of lists out like assets, and like all the different assets? Like, how am I supposed to know that cost of goods sold is?
Because you're supposed to know that cost of goods sold is an expense.
Yeah.
Like, do we just know that? There's no like list that we can study to know that?
I mean, that's something that you learned in Accounting 101.
I
mean,
know,
that
I just-
particular, well, so what you have to understand is what it represents. If you understand what it represents, then you would be able to, or define it, then you would be able to identify it as an expense. Like, when you see the word cost, you should think expense, because it's what I paid for the inventory that I'm gonna try to turn around and sell to my customer. Well, like, I gotta spend some money to make money, that's an expense.
Yeah.
You know, you might have to talk it out in your head, you know, the purpose, the definition. There might be, you know what, I'd have to look in the back of your book. I don't have, I mean, I have the book, but I don't have all of it with me. There may be in the back like a chart of accounts that has a very comprehensive list of accounts. Who has a book? Let me see that. I mean, you could probably Google it too.
Yeah, I was just curious.
Yeah, I mean, I don't know if there's such thing in here. I know there was one at the end of the Accounting 101 book. I don't think there's one in here.
Okay,
No.
okay.
Yeah, but again, cost of goods sold, always an expense. All right, so everybody good? Anybody have any questions? Other questions? So what comes next? We already talked about a trial balance, and I didn't have you do one, but I'm going to show this one to you. That's what this is. I wish it would say trial balance up here, but it doesn't. So this is a trial balance, and it is computed by literally starting with cash, right? Going to cash and grabbing that balance. Cash has a debit balance of $264. We come to the trial balance. We enter the individual account name and its balance. Why do we do that? Well, notice that we've got cash, accounts receivable, inventory, prepaid insurance, equipment, right? All debits. We jump over to accumulated depreciation, notes payable, our accounts payable, notes payable, common stock, revenue, all credits. We switch back over to expenses, and those are debits. The purpose of this is to make sure that I did those first two steps correctly. I journalized and I posted correctly. It's very easy to make a mistake. Now, I add up my debits, 471, I add up my credits, 471, I equal. Yay, woohoo, right? I wanna make sure that I'm correct before I go and do my adjustments, and then I go and prepare financial statements. So it's kind of a point where we just stop and check our work. If these two don't balance, I've got to go find my mistake. All right, so don't move on until your debits equal your credits. We're not quite ready to prepare financial statements yet. We've got to do adjustments. Now, what does that mean? Can someone give me an example of one of these transactions up here that we recorded in the month, that at the end of the month, now the balance isn't correct because time passed? Mike. Prepaid insurance, look. In March, right? Actually, I think prepaid insurance, what did that say it was for? I thought it was for April 1st, so nothing has expired just yet, huh? But I would have said the same thing without thinking about the dates. We got to think about the date. We actually wouldn't do an adjusting entry for that till the end of April, technically, right? But I like where you were going with it. You understand the question. Anything else you can see or think of? Probably not here. I mean, there's not a whole lot else here. I mean, this is it for this problem, by the way. But the next step we would take the balances from the trial balance and we would evaluate the accounts on the trial balance to see which ones needed adjustments. Now, how many of you remember adjusting entries and how we did adjustments? Oh boy. Well, I just so happen to have a handout for you. You guys are like, not another one. Oh, I'm the queen of handouts, I promise. So this is a two-sided thing, and what I've given you is the most common type of adjustments that you're likely to come across. And again, I give you these things so that you're not like, flipping through a bunch of pages in the textbook looking for, because it's all on different pages. Try to give you some guides here that like make your life a little easier by putting stuff down all on one piece of paper. I should count. I should have you guys get up and stretch, huh? The last few minutes. No. All right, so I just want to kind of show this to you, and I'm going to ask you to sort of take a look at something for Tuesday, because we'll do this on Tuesday. But so what I have here for you are just a list of the most common types of adjustments. Now, adjusting entries, they bring certain account balances up to their correct balance before we prepare financial statements. And Michael gave us a great example. Prepaid insurance, it expires. I don't have this much of a premium left, so I'd have to do an adjusting entry. It just so happens that adjusting entry is right here. It's a debit to insurance expense and a credit to prepaid insurance. Who remembers when we typically do adjusting entries? Give me a date. When do we do adjusting entries? When do we prepare financial statements? At the end of the year. Yeah, so if we assume that the end of our fiscal year is December 31st, we would do our adjustments on December 31st before we prepare financial statements. If we do quarterly reports, we might do quarterly adjustments, okay? So we've got to do adjusting entries. And they're journal entries, like as you can see. So I've given you some examples. So we have insurance when insurance expires. We have when supplies get used up. Here's depreciation. And that's our first category, which is prepaid expenses. Then we have unearned revenues. Do you guys remember unearned revenues? If I come to your house, if you say, hey, can you cut my grass while I'm on vacation? I'm just going to pay you now. And you give me $50 to cut your grass. Can I call that revenue today? No, because I didn't provide the service yet. It's actually a liability. I owe you the service of cutting your grass. I can't call it revenue until I actually come to your house and cut your grass. You gave me the cash, I got the cash, but I didn't do the service. So it's a liability in that case. Once I do the service, then I do this adjusting entry to record my revenue. And then we have accrued expenses. And then we have accrued revenues. Is any of this ringing a bell from Accounting 101? Little bells, huh? Then on the back, these are some other common adjustments. We've got there's the crazy thing happening again. We've got inventory shrinkage, which basically means, look, my computer says I have this much inventory, but when I go count it on my shelf, I don't have that much inventory. They have to match. Now, why would I have less inventory on my shelf than my computer says I have? Theft? What else? Spoilage, breakage, yeah, that kind of stuff, right? So I'm going to make an adjustment for that at the end of the period when I actually do a physical inventory count. And then the last one, provisions. This is just one example. When I estimate the amount of my accounts receivable, I don't think I'm going to collect. Okay, so I'm going to ask you guys to try something between now and, wait, today's Thursday, huh? 2 things I want you to do for me. You guys ready? This doesn't really have anything to do with adjustments, but this is good practice. So for the weekend, I want you to work on exercise 2.6 on page 93. Hey, I gotta find a spot here. Page 93, exercise 2.6. Practice with your debit and credit rules. And then, let's see how much you remember from doing adjustments. Don't be scared, just practice. Exercise 2.9 on the next page. assist you with some of these adjustments. Obviously, you can check out your textbook. The PowerPoints have examples of adjustments in them. I did not get a chance to show those to you, but you can read through those as well. There's a whole list of examples in the PowerPoints too. Remember, this is review, so I do expect you to review. If you don't have any questions, all right, you guys can go. Please make sure you're reviewing. Yes?
Did you pull up that trial balance again?
Sure. Have a good weekend. This one, Christine?
Yeah, thanks.
So